Hi everyone, welcome to the 13th, lucky 13th episode of This Week in Investing and Finance. Just sort of my views of the finance and investing world. It's July 16th. Quiet summer for the markets. I added a few different metrics to watch that I watch, and hopefully you'll start watching. One thing I noticed is Bitcoin is evaporating as we speak. The only reason this is interesting is the markets are up a lot, and risk seems to be the markets seem to want risk. So the idea that Bitcoin is down is truly interesting. Again, it could be a blip, it could be the beginning of the end. I'm not sure anybody knows. I'm kind of bullish on Bitcoin, so we'll see what happens. Tech is continuing its insane non-stop performance. I think it's merited, by the way, but it's still breathtaking nevertheless. The companies in question are delivering the earnings, so in many ways, the rally is very much meritorious. But it's still breathtaking that all you needed to do to beat the market significantly this year was be long tech and short everything else, and you'd be very happy. So the most efficiency in our economy comes from these types of companies, and that's sort of what's driving this success. The dollar's weakening kind of across the board. I think people expect that rate increases in Europe and other territories will happen faster than the U.S., which certainly seems to be true. Although, again, there's a lot to talk about there. The economy is extremely healthy from what bonds are saying, from employment, inflation. We're really in a kind of paradise nirvana type scenario right now. So it'll be interesting to see how that continues to play out. But at the moment, things are looking extremely good. So in any event, I guess you guys are telling me the volume is low. Let me see if I can get that a little louder for you. Let me know if that's good or not. So in any event, that's sort of what's going on there. A couple things that I thought I'd monitor with you guys a little bit on a weekly basis. The 10-year is at 2.33%. I'd like to joke that in an interview sometimes I'll just look somebody in the eyes and ask them what the 10-year is yielding, and if they're off by too much, I won't hire them. All jokes aside, I mean, you should know what the 10-year bond is yielding, and the 2-year at that, but the 10s and the 2s and the spread between them is very important. Then I started, I'm adding LIBOR. This is a 3-month LIBOR, which is 1.3%. Moody's has this aggregate AA and BBB index, or BAA index, and these are corporates, obviously. So the corporate bonds are tracking their yields is really important. I'll talk about that in a second. And finally, the so-called TED spread, which is the spread between LIBOR and Treasuries. Basically, it's the idea that the TED spread will widen when banks are experiencing stress. This is a really important thing to watch, amongst other things. But the TED spread is actually reaching almost historic lows, I would say. And part of that is the great strength that the 2008 recession or depression, or whatever you want to call it, resulted in a huge restructuring of banks with Basel III and things like that, such that banks are now almost impenetrable to risk. Of course, we did see a Spanish bank fail 2 weeks ago, so maybe it's not totally true, but at least the TED spread is contained right now. So anyway, something to think about. So what I thought I'd do is do this little chart I made in 5 minutes that shows rates. And what's interesting about rates is a lot of people, here's one thing I added, which is the S&P 2018 earnings yield. So basically I took the S&P 2018 earnings, which is, and I'll show you how you can do this. There's multiple ways to do it, but the easiest way is to get the S&P earnings for 2018, which is published not just on Bloomberg, but in a lot of places. And what you're looking for is basic earnings. And so banks publish this, many folks publish it, and you can see that S&P earnings are expected to be $146 in per share in 2018. And if we just do a lot of people are tempted to do the PE. So you have the index price, and you've got the earnings per share, 46. A lot of folks are tempted to do the PE, which is 17 times earnings, and that's not really too, in my opinion, too easy to interpret. But if you do it the other way, as an earnings yield, well, this makes a lot more sense. It's basically a 5.94% yield, because this is what you're getting, right? 146, and this is what it costs. So like a bond that costs $1,000 that's paying you a coupon of $50, this is a 5% bond coupon at least. And the thing about the S&P is that those earnings will theoretically grow, which makes them even more interesting. So this is sometimes called the Fed model. But in any event, the point is that I think the 6% yield is real. So that's sort of the S&P 500 2018 yield. Now, the actual dividend you get, companies don't return all of their excess cash to shareholders, obviously, but I don't know that matters, whether they keep it on the balance sheet, use it in acquisitions, or return it to you. It should be functionally irrelevant, so we'll sort of keep that in mind. But you can see here that the S&P earnings yield is about 6%. And I tried to stack these up. Obviously, in some ways, the S&P is not a 30-year obligation, so I mean, hypothetically, it sort of should belong over maybe here somewhere, maybe able to span this, quite a bit. But as you can see here, you have some negative yields in Europe. The German bonds are yielding negative amounts. Of course, there's priced-in deflation over there, but the 10 and the 30 years are yielding positive. This is a normal yield curve, other than the abnormal negative yields. You have LIBOR. You have some of the U.S. bonds here with, again, a normal yield curve. And then as you go up the risk curve, you have corporates that yield higher than treasuries and sovereign bonds, obviously. And then you have these corporates. So this is more junk corporate, and this is more well-rated corporate. But the point I'm trying to make, and here are some junk bonds, Mallinckrodt and Valiant are yielding 7 and 9%. One of the things that's important to understand when you think about discount rates, and there's a reason the word rate is in there, is you're trying to sort of assess the risk of an asset. And you can obviously see, like, the Valiant bond is pretty risky. Valiant may or may not make its interest payments, etc. Whereas, say, the German bonds or the U.S. bonds, these are more, they're probably the same amount of default risk, but their inflation component is very different, where there's inflation here and deflation there. And then you have things like J&J, which really embody equity risk premium more than they embody anything else. And then higher yield stuff like, say, a Regeneron, which isn't too risky, but you never know. Anyway, the point is you have to really think about bang for the buck when you think about risk and reward. And you can buy Valiant bonds and get 9%. And it's the same maturity as a 2% yielding U.S. Treasuries, but totally different risk profiles. And that just seems very obvious to you, but basically when you think about a DCF, if you put a 2% discount rate in your DCF, it'd be quite the interesting DCF. If you put a 9% interest rate discount rate or a 12% discount rate, it'd be quite different. So I think this helps you, having this in mind sort of helps you think about what discount rates are. And if you take a look at J&J, the inverse earnings yield, if you will, of J&J is something like, in other words, the inverse PE. Let's take a look here. J&J is going to earn, do it this way, $7.11 over $132.60. So 711, 132. It's about 5%, about a 5% earnings yield. So I'd rather buy J&J stock and make 5%. Than buy the bond and make 2%. Now the bond is senior, of course, to the stock, but I don't think J&J is going to default. And a 5% yield is a pretty handsome yield. Now, again, when I'm thinking about discount rates, I can think about J&J as a low discount rate, and another company maybe has a higher discount rate. But this gives me a bit of an opportunity to sort of think about think about discount rates in your models, and rates in general. So anyway, we'll move on from that. It's been a quiet month, not a lot going on. Arena had this big news, which we'll talk about, and so did Amicus. This isn't going to be a very long session, but let's see. So there's, again, very, very quiet month. Earnings season just about to start next week, so enjoy that. So a little bit of quiet before earnings season starts. We got Sangamo, so a lot of you guys have been sending me messages about Sangamo. Very happy you're making money on it. We got Neurotrope is starting to fall apart finally. We'll talk about that in a minute. So again, pretty quiet month so far, but earnings season begins in full swing probably Monday, or really Tuesday. Most companies don't report on Monday, but Tuesday should begin the harrowing process of tracking all these companies' earnings, and usually you'll get some moves based on whether or not they had a good week. Anyway, I added Almirall, which is a Barcelona company that had a really bad sort of blow up. So we'll talk about that. I mentioned Global Blood once or twice. I'm spending a lot more time on this one. Could be really, really interesting. Everything else is sort of the same. The portfolio had an amazing week. So pretty much everything worked. Neurotrope fell a lot. The rest of the shorts kind of hung in there, and the longs did really well. So up 1.4% brings us to 7.11%. And I did a little bit of statistics. 83% win rate. I've invested in about 30 securities this year, and we've had an amazing run. And the median IRR is about 75%, which is pretty amazing. So even though the portfolio has only returned 7%, the IRR has returned roughly 75%. And what that means, kind of interestingly, is we've got 7.11%, but you'd have to sort of triple that roughly for the gross exposure being so low. So the gross exposure is pretty low. And then you've got, we sort of had 4 out of 6 months. So let's see. So we're the adjusted performance for a year. Now this is only half a year. Would be in the 75% range. So pretty much the best investing I've ever done for these first few months. So some of y'all have been very lucky and watching this and saying, "Oh, Martin, you're doing so well. How could you be doing this well?" And the reality is this may or may not last very long. So we'll see if that'll continue. But I like these positions. They all make sense to me. I've vetted them very carefully. Hoping to add a few more interesting ones, like if Global Blood checks out, that could be a pretty big winner. I think Ironwood and Fibergen could be pretty big shorts that I have to look into a little bit more. I always want to invest more in these stocks, but it takes some time to sort of make sure that you feel comfortable with them. So Taro is also, I think, an intriguing long. But again, there's only so many hours in the day, and one has to sort of fixate on completing diligence, which isn't easy. So some of these companies have known for such a long time, it's a little easier, but something like an Avexis really takes an awful lot of time to get comfortable with. And something like a Macrogenics, again, really exciting company, would love to spend more time looking at it and learning about it. But again, only so much time in the day. I do have my startups to focus on. But one of the things, again, you might have seen this performance and said it's incredible. Again, assume that it's temporary, and I'll sort of revert to mean, if you will. But one of the things that comes up is how do you think about your portfolio? Now, 83% win rate is very uncommon, but Warren Buffett has a win rate similar to that, and it made me start thinking about something that I think the folks at SAC Capital, or Point 72, or whatever they call it now, think about, which is this wholly sort of triangle of how you frame an investor or a trader. So just on the S&P, my IRR is about 75%. The S&P is up about 10% this year. So you have to think about IRRs. I've only had this portfolio for 3 months, and the gross exposure is about a little less than half. For a while, it was about a third. So if you take an aggregate, it's been a really, really amazing portfolio. Pretty much every stock has worked. Like I said, 83% win rate. Very, very lucky for that. So anyway, hopefully that explains it to you a little bit more, Shlomo. Anyway, the triangle is interesting. The basic concept is that there's some 3 variables that explain all traders, and this is sort of what mine looks like. And so the idea is that the win-loss accuracy is actually pretty easy to succeed at if you don't make many bets throughout the year. So like for instance, if you pick 3 stocks for the year, you said, I'm going to short Snapchat, I'm going to go long Regeneron, and I'm going to short Neurotrope, that's going to have a 100% outcome. I mean, those are 3 relatively secure calls. Neurotrope is basically a fraud. Snapchat is very overvalued, and earlier in the year, Regeneron was very, very, very undervalued. So if you really focus in on a few stocks for the year, again, maybe you're not going to hit 100%, but something like 80% is very doable and achievable. Now, if you start trading a lot more stocks, say this is a healthcare and tech combined universe, that could be 2,000-3,000 stocks, and let's say you traded 500 or 600 of them. Well, you're not going to get a win-loss ratio of 83%. It would get closer to 50%, or maybe even below 50%, and you can still make money below 50%. These aren't 3. Clearly you always want your win-loss as high as possible, but these are more 3 attributes to describe a trader, not to say that you want all 3 as big as possible, but there's always a slight trade-off. So throughput is sort of works on the other side of accuracy, right? You can turn over your portfolio and shove more capital through your portfolio if you focus on more stocks, but it'll hurt your win-loss ratio. It'll impinge on that. And so these 2 lines sort of go against each other. So this is like a Warren Buffett private equity style, where I'm going to pick 5 or 10 stocks, or in my case, again, 20 or 30, but it's not 200 or 300. I don't enjoy the diversification of a lot of other portfolios. I've got a big, sticky 6% position that didn't look so great when Bloomberg's article came out. Avexis didn't look so great sometimes. So you're not always going to enjoy the benefits of diversification if you're going to focus on accuracy and pure success of your stock picks. Of course, the other concept is sort of how you stop out your losses. So if every time you're right by 10x, and every time you're wrong by 10%, and you have a great stop loss somehow, you can increase your throughput and your win-loss ratio basically doesn't matter at that point. If you're swinging every time you win, it's a home run, and every time you lose, it's not. Now, the opposite often occurs where wins are very small, losses can be very big. Say, like if you're writing vol, for instance, your win-loss ratio, I'll give you a good example. So vol writer is win-loss is 90%, and his turnover is infinite. You can write every option on the planet, but the problem is that the dollars won, dollars lost is very very adverse. So you can have a sort of 2 that are really good here, and this one being really bad because of the way volatility works. So if you just sell options, this is sort of where you're going to come out. You still might make money, but the concept is in essence you're just short the VIX in many ways. So in any event, that's sort of one sort of way to think about it. So this is sort of what mine looks like. This is more of like a high frequency trader or a quantitative hedge fund, has close to infinite throughput and velocity, but obviously the other way, there's so many different ways to make money, but this is sort of one of the ways to think about what kind of a trader are you, and how to maximize all 3 of these to get better success. So there's some news that I thought I'd mention. Pascal Soriot leaving, staying, AstraZeneca, Teva. Really interesting to see a CEO so loved that Stocks move 5 or 6%. Huge companies based on the CEO. Pretty cool stuff there. New antibody approved from J&J. It should hurt AbbVie over the long run. All these new antibodies, second gen immunomodulators, maybe make the TNF alphas go away over time. Roche biosimilars are coming. Never thought I'd see the day when it was 2000 and a very young Martin Shkreli was 17 or 18 years old, and biosimilars were the big threat to the biotech industry. They're finally here 17 years later. So I think that there's going to be some final impact here from biosimilars. Having said that, again, it's certainly better than generics. Biosimilars are not going to be as fast eroding as generics, and they're big opportunities for companies like Amgen and Mylan. And they're obviously big problems for Roche, but at the same time, emicizumab, the new Roche drug, or Chugai drug, I should say, is some people are saying could be a $5 billion drug, which is pretty amazing. The hemophilia space is really undertaking this massive change, and I think companies like Sangamo, I've mentioned before, are going to have great success. But at the same time, emicizumab is definitely an interesting asset and could not bode well for Sangamo. Again, one has to sort of consider the entire space. Affinity was published in the New England Journal. Oh man, what a bad study. Pertuzumab is really not as good as anyone thought it was going to be. I can imagine, I have Pertuzumab sales stopping here basically in terms of growth, and maybe even they'll reverse. Probably the most important news for the week was Amicus's drug, migalastat or whatever you call it. Basically the FDA first said pre-Trump that they wouldn't approve the drug. This is for a very rare disease, and they would need another phase 3. But now the FDA is willing to approve the drug as is. So pretty amazing reversal of fortune for Amicus. But it means something for all drug companies, I think. The new FDA commissioner, well, I'll take a step back. Most FDA commissioners are... sorry, one second here. Most FDA commissioners don't get involved in drug approvals. So what's interesting is there's a kind of a new sheriff in town, and it seems like Dr. Gottlieb is going to be more involved sort of directly with FDA approvals, which is somewhat interesting. Anyway, that's sort of, I think, really important news, and again, certainly benefited one company to a great degree. There was some interesting data from Cadman and Graft versus Host. That was interesting. Almirall had a terrible blow-up. Shares look pretty cheap. Alnylam and Genzyme reported some data. I thought there were some interesting toxicity signals there. It could bode poorly for Alnylam's entire portfolio. Tesaro's not going to get a buyer, and of course Arena had some interesting pH data. If any of this was news to you throughout the week, go back and take a look at it. Really interesting stuff there. Not a lot going on in tech. Again, we're waiting on Q2. I noticed Benchmark is trying to sell Uber. That was really intriguing. PC shipments are the lowest since 2007, and one has to wonder if in 10 years the word phone or smartphone or small mobile PC we carry around is going to be replaced in this sentence. So again, be wary. Only one of these companies really survived as a great success. So if Samsung, for instance, and Apple are at all-time highs right now, so it's possible that it could reverse. Uber threw in the towel in Russia and partnered with Yandex. Again, somewhat interesting stuff, but again, quiet on the tech front, and I'm very, very busy and couldn't look at all tech news this week. A couple of questions before we call it a day. This will be about a half-hour stream. Yeah, rest in peace, Gateway, indeed. Someone asked me what I meant by saying the primary care model is broken. Well, it's more empirical. There's very few primary care drugs that are selling well. Things like drugs for overactive bladder or constipation or obesity or what have you. These drugs just aren't selling well, and that's sort of what I meant by that. And Ironwood is sort of the lone company willing to say, no, I think we can still we could still sell drugs to the mass market general practitioner, family practice doctor. Steve asked me about the maturity rate I use in models. Most of the maturity rates he sees are in the positive territory, mine are in the negative territory. Well, Steve, if you standardize your maturity rates across companies and you feel comfortable that the average model you're making leads to a balanced average return, which when you look at my models, they have a central tendency of around 0% as the average return. That's what you're looking for. You need a system that gets you a 0% return on the average company, so that when you do get a big return, you can trust it, and when you get a bad return, you can trust it. But the central tendency should be 0. If I added points of growth and maturity to my models, they would overvalue each company. So I'm pretty happy with my system. And if you look at long-term growth rates for anything, they're not positive usually, net of inflation. So I don't know. Sam asks, are you ever worried about an acquisition messing up your short sale? And it's a cute question. It's clearly a beginner's question, but many professionals ask about it as well. I never worry about an acquisition blowing up a short thesis. If a bigger company acquires a company you're short, you made a mistake. Just semantically, you messed up, and it's your fault, and that's that. Anyway. Let's go to hard to borrow fees. Albert asks about this. It's absolutely true that most great shorts are very hard to borrow, but if you add up the fees, you end up getting a sort of a good return if you're quick about your short. Certainly hard to borrow fees are a part of short selling, and you have to calculate what you think you're going to get out of the position. But in my career, hard to borrow fees have definitely, taken out a little bit of my return from shorts, but not enough that it's scared me away from shorting. Is there a ceiling on drug prices? Asks Emilio. It's a lot easier when you have a long duration drug. So if you have a drug like Soliris, it's a $500,000 drug or whatever, and then the number of years you're expected to take it, or let's say 20 years. So the total tech term is total cost of ownership is $9.6 million. Now if you take a drug like, I don't know, say Daraprim, drug price is $25,000, and the number of years you're supposed to take it is 1. You take it 1 time, and you can see that the total cost of ownership is the ratio here, it's not even 1%, right? It's 20 basis points of the same cost. And these are both rare, deadly illnesses. So the fact that you have to take one of them forever, and one of them you can take once, I mean, this is, you would argue, the better drug, right? Because you only have to take it once. But at the same time, the market bears this $10 million drug, and the market is upset about my $25,000 drug. And part of this is just the optics and natural stupidity of the masses. But part of it also is this concept that there is an upper limit on drug prices to a certain extent. But at the same time, I think that for an acute drug, it becomes a little more obvious. Like if you look at Sovaldi, is around, I don't know, $50,000 net of all fees and things like that. We've seen sort of natural ceilings in this range for an acute care medicine, and we've seen natural ceilings in this range for a chronic medicine. And the market's sort of mysterious. The unseen hand, invisible hand, guides us, and that's about all we really have to go on. But there is no practical ceiling to some extent. Jay asks the favorite investors I follow and if any stock picks. I'll never buy a stock just because a friend likes it. I think I maybe have one friend like that in the world for the last 20 years that I follow the markets, that I will actually follow his or her advice without doing my own homework. And I definitely don't think you should follow anyone's advice. When I put out this portfolio, part of it is fun for me to see that I can invest very well, and I like to sort of practice investing and showing the world how I invest, and hopefully I'll learn something and you agree with some of the stock picks, but you shouldn't blindly copy anybody's portfolio, and I certainly don't do it. How fun is investing for you? I think anytime you're having too much fun investing, you're probably doing it the wrong way. Investing shouldn't be too much fun. It should be really hard work. I mean, I've mentioned many times that for every 10 or 20 stocks you look at, only one or two of them should be good longs or good shorts. And that's not that much fun. Now, if you really love the stories of business, you love the stories of investing, that part is fun. I was reading the Comcast 10K the other day. It's not the kind of company I usually look at, but it was fun to sort of take a fresh look at a company I haven't looked at in many years. And that's fun for me. But at the same time, looking for stocks and doing hours and hours of research shouldn't be too much fun. It is a job, and it is stressful, so it shouldn't be that much fun. Anyway, that's really it. Thanks for everything. I've been reading a lot of medical literature. I'm kind of focusing back on my drug assets again. I have a lot of different drug assets around the world, and I have a ton of research I have to do on those. I've been reading this book in court, medicinal chemistry textbook. This is the third textbook I've polished off while in court. If you have any questions, you can always email me. I'm very accessible at martin@thoughtpatrol.com, THOTPATROL.com. If you like this series, I think you'd love our new software startup that I'm the CEO of, called Godel Systems. Godel is a fascinating new software company based in New York. Like I said, that I started and manage. Just go to godel.systems to sign up. It's a pretty secretive sign up. You got to sign a CDA to sign up, but I think you'll enjoy it. Anyway, that's it for me. Thanks so much for catching the series, and I'll see you again on next Sunday. Bye.